you're in a situation where you want to pay off your mortgage fast, and then and then focus on your credit cards later or what have you, right? So the what's wrong with that strategy is your mortgage typically has a better interest rate than your credit cards. So if ideally, if you could time it perfectly, if you could pay off your mortgage right when you're going to retire, that's the perfect strategy, right? Like and so that means so even if you pay it off, right? Like you get the mortgage, you're making the mortgage payments, and then you pay it off. You could take a second mortgage out rather than getting a credit card, right? Or take some equity out of your house to make it so you're paid off soon, because you're probably not going to get better interest rate than a mortgage, right? So you want to kind of keep a mortgage right up until your retirement. And then as soon as you're done retirement, then you're like, okay, no more mortgage. I just have to worry about property tax, and then you're all set, right? So basically, you want to have it paid off, and then if you do that, one thing to do, like just say you're young and you retire now you paid off the mortgage, right? You paid off the mortgage, and you don't have much credit card debt because you liquidated equity from your mortgage throughout your life, and so you have very little credit card debt, like, which is high interest rate. Like most mortgage payments are most mortgage interest rates are very low, right, compared to credit cards, right? So that being said, so now you retired, what you could do is you could take a reverse mortgage on your house. Like just say you're 50, 55, or 60, right? You're still in good health. So what you do is you take a reverse mortgage out on your house. Like just say the house is worth well, it doesn't matter. Just say you wanted to liquidate, say $100,000 or $200,000 worth of equity, right? And you wanted to start a new 20-year mortgage, and so then basically you would get all that equity, and then you could have it paid out monthly, and with that you would see, like, ideally you're eligible for life insurance for this strategy, and then you would get term life insurance, and so should you pass away, the term life insurance, you wouldn't get it through the bank though, you get it through a life insurance company, like the mortgage insurance, and because should you pass away, and then especially with your term life insurance policy, when you pass away, if you were to, then that means you're going to have more than the balance of the house is going to be paid off, and you're going to end up with cash in your spouse's pockets or your beneficiaries' pockets, right? Which is the main thing as the breadwinner approaches death. They do think about how they can bequeath their assets the best way to their beneficiaries, right? And so one way to do that is if you do get a mortgage, because I used to be a financial advisor, so if you do get a mortgage, don't get the bank insurance for the mortgage, because it only pays off the balance of the house, right? If you go through an insurance company and get insurance through an insurance company on the mortgage, then should you die, not only is the balance paid off, but you'll have hundreds of thousands of dollars, most likely. If you had $1 million policy, right, and just say they paid off $50,000, right, then your spouse is going to end up with $950,000, right? Whereas in the same scenario, if you went to a bank and had bank insurance for the mortgage, then they'd only pay out the $50,000, right? And you're paid in all those years, and your spouse would only get $50,000. It was sure they wouldn't have to worry about the mortgage, that's what they're everybody would be happy with that, but they just don't realize the big picture, that there's a better option out there, which would be life insurance, mortgage insurance, right? To be able to end up with a policy that covers you. So, so once again, if all of a sudden you're 60 or retired, your house is paid off, you're in good health, get it in, like, take a reverse mortgage out and then turn that into an annuity. So just say you had $200,000, you could have a certain amount paid, like, you say maybe $800 a month for 20 years or whatever it would be, and let's see what it would be. Here, one of my favorite apps on the phone is a calculator. So 200,000 that's a million, 2 million. So let's see, divided by. So there's 12 months in a year. So so let's see, bracket 12 times 20. 20 bracket. So yeah, you'd be getting an extra $833 dollars per month, right? So now with the $833 per month, you'd be able to pay your mortgage off, the mortgage payment, and get some term life insurance, and then possibly have a couple $100 in your pocket extra per month, right, to live, right? So, and the whole premise of this is if you're paid off at like say 60, and then you do the reverse mortgage and then you pay it off by the time you're 80, the price of the house should have appreciated in value, that it would have offset the differences if you would have sold it at 60, right? So it should be a win-win-win all around. The only thing that would derail this would be medical expenses, right? So that's why you have to get life insurance before you have any medical issues. But definitely consult, get a financial advisor so you can consult about your own unique needs and your own situations based on your circumstances.